A lot of your viewers are probably a little bit shorter term with a little less capital than Scott, right? And that's saying it mildly, meaning I don't think most people want to buy the equity market before the imminent fixed income disaster that he's forecasting. That feels wrong to me. But I know what he means. He's probably not been involved in equities and been right and trying to figure out when to make a multi-year investment. So I think there's always a kind of a mismatch of assets and timing. My own personal view is that it's really hard to know what the Fed's going to do. We know, and I say this all the time on this program, these guys were buying billions of dollars of mortgage-backed securities when housing was amazing in every MSA. So they could continue to be hawkish, and they've kind of on that path. And I feel like we'll know next Thursday with the CPI, another data point, it's going to be high. Yeah. Right? I know it's going to be high. So I don't know if the data short term, I know we mentioned the jobs report, I don't know if we're going to get enough dovish data in the near term. I thought his point on November was kind of interesting. That's clearly out of consensus if they get dovish by then. So I'm more focused on earnings, and I think earnings are going to be bad. I think guidance is going to be bad, and I think the key performance indicator we're focusing on at Trivariate is inventory. Because I know a week or two ago when we were on together, you saw Nike, you saw Micron, you started to see some weaker inventory numbers, and I think that's the main thing I'm focused on in the next week or two as earnings start unfolding.
And of course, again, the big question is, has the market got part of the way there, right? In terms of figuring out that things are not going to live up to expectations.
I think part of the way, and I think maybe that part of what Scott said I agree with. Like, we're down, but we probably could go down more. We think earnings estimates are 15% too high for next year. That's, I think, an interesting debate that I've been warming up to the last 2-3 weeks is, are we sure 2024 earnings are going to be above 2023? Yeah. Or could it just be we have a very high nominal GDP now, it's starting to come down, and maybe it's just going to be a very slow bathtub shape sort of thing and not the V shape that's currently in most institutional investors I talk to. They're underwriting 2024 numbers being above 2023. Right. And they need that to get the valuations to look, once in a lifetime attractive at a minimum. Right. So I think that's an interesting debate. Let's see how. Right.
If the Fed gets inflation, let's say it's down to 2-3%, nominal growth is not great.
Right. Yeah. I don't think there's any way mathematically they get to 2 to 3% anytime soon. They need a colossal recession to get there. So I think what they should do is just say, look, we ran below 2 for a decade, made you believe deflation wasn't a problem. We're going to run above 2 for a decade, make you think hyperinflation is not a problem, and maybe equities, they can kind of massage the language. Yeah. I think another important point is the reason people want to own equities when the Fed gets dovish is they think the price to earnings ratio is going to expand, right? That's what they're saying. Sure. But remember, the price of the market is the price to earnings times the earnings, right? You cross out the E in the numerator, cross out the E in the denominator, get the price, right? So the problem is, as they get dovish, it's probably because their earnings are coming down. And so I have a little bit less confidence that cocktail is so enticing at this point. Well, it's still early in the downward earnings revision.
Well, and history does say that the first cut is actually not one to buy if you've been in a recession. So we'll have to see how that goes.
That's right.
Sit tight for a minute.